Good morning, traders, investors in Asia and Europe and Africa, and loyal viewers of Alpha Market Meridian. This is your daily financial analyst, bringing you a deep dive into two of the most traded currency pairs in the world, Euro to US dollar and Pound sterling to US dollar. Right now, both pairs are navigating a volatile landscape, shaped by central bank policy divergences, economic data surprises, and geopolitical ripples across the globe. Today, we're not just going to tell you where these pairs are trading, we're going to break down their charts, unpack the latest news driving their moves, and give you 3 actionable, risk-managed strategies for each pair, so you can turn this volatility into consistent profits. Whether you're a beginner just dipping your toes into Forex trading or an intermediate trader looking to refine your approach, this script is your playbook for trading Euro to US dollar and Pound sterling to US dollar in the next 1 to 2 weeks. First, let's start with the charts you see on your screen. We're looking at the 60-minute intraday view and the daily trend chart for both Euro to US dollar and Pound sterling to US dollar, because understanding the short-term momentum and long-term trend is the foundation of any profitable trade. Let's kick things off with Euro to US dollar, the most liquid currency pair in the world, currently trading at 1.0824, up 0.21% in the session. But don't let this minor intraday rally fool you, we need to dig into the technicals to see if this is a genuine reversal or just a dead cat bounce. Minute intraday chart for Euro to US dollar. Let's break down the key moving averages first, because they're the backbone of technical analysis for Forex pairs. The 5-period MA sits at 1.0818, the 10-period MA at 1.0805, the 20-period MA at 1.0792, and the 40-period MA at 1.0788. Notice the alignment here. The shorter-term moving averages, 5, 10 period, are above the longer-term ones, 20, 40 period, and the current price is trading above all of them. That's a short-term bullish signal, but we need to confirm this with the MACD indicator. The MACD on the 60-minute chart is above the zero line, with a bullish crossover that occurred yesterday afternoon, meaning short-term momentum is shifting to the upside. The histogram is printing green bars, which are getting slightly larger, indicating that buying pressure is building, but we're not seeing a massive surge yet. This is a cautious bullish signal, not a full-blown rally now. Let's zoom out to the daily chart for Euro to US dollar, which tells the longer-term story. Since peaking at 1.123 in early March 2026, Euro to US dollar has been in a gradual downtrend, carving out lower highs and lower lows. The 50-day MA, which acts as a key dynamic support resistance level, is currently sitting at 1.0856. Notice that the current price is still below this level, which means the longer-term trend is still bearish. The 100-day MA at 1.0921 and 200-day MA at 1.0987 are even further above, forming a wall of overhead resistance. The MACD on the daily chart is still below. The zero line, with a histogram printing small red bars. This tells us that while short-term momentum is bullish, the long-term bearish momentum hasn't been broken yet. So, Euro to US dollar is in a short-term bullish pullback within a longer-term bearish trend, a critical distinction that will shape our trading strategies. Now, let's move to Pound sterling to US dollar, currently trading at 1.2648, up 0.35% in the session. Like Euro to US dollar, Pound sterling to US dollar is showing short-term strength, but let's break down the charts to see if this is sustainable. Starting with the 60-minute intraday chart, the 5-period MA is at 1.2642, the 10-period MA at 1.2630, the 20-period MA at 1.2615, and the 40-period MA at 1.2608. Again, we see short-term bullish alignment, shorter-term Mars above longer-term Mars, and price above all of them. The MACD on the 60-minute chart is above the zero line, with a bullish crossover that happened earlier today, and the histogram is growing, indicating stronger buying pressure than we're seeing in euro to US dollar. This suggests that GBPUSD's short-term rally is more robust, but we still need to check the daily chart for the longer-term trend. On the daily chart for pound sterling to US dollar, the picture is slightly different from euro to US dollar. Pound sterling to US dollar peaked at 1.3012 in late February 2026, then pulled back to a bearish, but the short-term recovery is stronger than EUR to USDs. The MACD on the daily chart is still below the zero line, but the histogram is shrinking, meaning the bearish momentum is weakening, and we could be seeing a potential trend reversal if the price breaks above the 50-day MA. This correlation between euro to US dollar and pound sterling to US dollar, both in short-term bullish pullbacks within longer-term bearish trends, is key, because it means we can use similar strategies for both pairs, but adjust for the differences in momentum. Now that we've broken down the technicals, let's dive into the latest news and fundamental drivers that are shaping these two pairs. Remember, Forex trading is all about interest rate differentials, economic data, and central bank policy, so we need to stay updated on the latest developments from the Federal Reserve, Fed, European Central Bank, ECB, and Bank of England, BOE. All of the news we're about to discuss is from the last 72 hours, so it's fresh and directly impacting the current price action. First, let's talk about the Fed, because the US dollar is the counterparty in both euro to US dollar and pound sterling to US dollar, so any move from the Fed has a direct impact on both pairs. Yesterday, the Fed released its latest FOMC meeting minutes, which showed that policymakers are still cautious about cutting interest rates, with most members agreeing that inflation remains too sticky to justify aggressive rate cuts. The minutes revealed that only 2 out of 12 FOMC members support a rate cut. In June, with the majority favoring a hold until at least September 2026. This is a hawkish signal for the US dollar, which would normally weigh on euro to US dollar and pound sterling to US dollar, but wait, why are both pairs rallying today? Because the market had already priced in this hawkishness, so it's a classic case of buy the rumor, sell the fact. Now that the minutes are out, the dollar is pulling back slightly, giving euro to US dollar and pound sterling to US dollar room to rally in the short term. Next, the ECB, which is the driver of the euro. Earlier today, ECB President Christine Lagarde gave a speech in Frankfurt, where she hinted that the ECB could begin cutting interest rates as early as July 2026, but only if inflation continues to cool. Lagarde stated that core inflation is moving in the right direction, but we need more evidence that it will stay below 2% before we begin easing. The latest Eurozone inflation data, released 2 days ago, showed that core CPI fell to 2.8% year-over-year in April, down from 3.1% in March. This is a positive sign for the ECB, but it's still above the 2% target. So, the ECB is leaning dovish, but not aggressively so. This means that the euro's short-term rally is likely to be limited, as the ECB's rate cut path is still uncertain. Now, the BOE, which drives the British pound. Yesterday, the BOE released its latest inflation report, which showed that UK inflation fell to 3.2% year-over-year in April, down from 3.4% in March. This is the lowest level since early 2022. The BOE's Monetary Policy Committee, MPC, voted 6-3 to hold interest rates at 5.25%, with the 3 dissenting members favoring a 25 basis point rate cut. This is a slightly dovish signal from the BOE, but unlike the ECB, the BOE has not hinted at a specific timeline for rate cuts. However, the market is pricing in a 50% chance of a rate cut in August 2026, which is supporting the pound in the short term, hence the stronger rally in pound sterling to US dollar compared to EURUSD. Other key fundamental drivers include economic data from the Eurozone, UK, and US. In the Eurozone, retail sales data released yesterday showed a 0.3% month-over-month increase in April, beating expectations of a 0.1% increase. This is a positive sign for consumer spending, which is supporting the euro. In the UK, GDP data released 3 days ago showed that the UK economy grew by 0.2% in the first quarter of 2026, avoiding a recession, which is boosting confidence in the pound. In the US, jobless claims data released today showed that initial jobless claims rose to 215,000 last week, up from 208,000 the previous week. This is a slight weakening of the labor market, which is putting pressure on the US dollar and supporting euro to US dollar and GBPUSD. Now, let's talk about the correlation between euro to US dollar and pound sterling to US dollar. Over the past 30 days, the correlation coefficient between the two pairs is 0.85, meaning they move in almost the same direction. This is because both the euro and the pound are major currencies paired against the US dollar, so they're influenced by the same Fed policy and US economic data. However, there are key differences. Pound sterling to US dollar is more sensitive to UK economic data and BOE policy, while euro to US dollar is driven by Eurozone data and ECB policy. This correlation means that we can use similar strategies for both pairs, but we need to adjust our entry and exit levels based on their individual momentum and key support resistance levels. Let's outline the key support and resistance levels for both pairs, because these are the levels that will guide our trading strategies. For EURUSD on the upside, the first major resistance is the 50-day MA at 1.0856. Breaking above this level would confirm a stronger short-term rally, with the next resistance at 1.0900, a psychological level, and then 1.0921, the 100-day MA. On the downside, the first support is the 20-period MA on the 4-hour chart at 1.0792, followed by the recent low at 1.0753, and then 1.0700, another psychological level. For GBPUSD on the upside, the first major resistance is the 50-day MA at 1.2715, followed by 1.2750, a psychological level, and then 1.2783, the 100-day MA. On the downside, the first support is the 20-period MA on the 4-hour chart at 1.2615, followed by the recent low at 1.2489, and then 1.2450. Now, the most important part, actionable strategy will include specific entry points, stop-loss levels, profit targets, and detailed operation rules, no vague suggestions, just executable steps that you can apply today. First, Euro to US dollar strategies. Strategy 1, buy the dip, beginner friendly, low risk. This is the most straightforward strategy for beginners, as it leverages the short-term bullish pullback while managing risk tightly. The goal is to buy euro to US dollar when it pulls back to a key support level, ensuring we're not chasing the rally. Here's the step-by-step. 1. Wait for euro to US dollar to pull back to the 20-period MA on the 4-hour chart, which is currently around 1.0792. This is a key short-term support level, and buying here gives us a favorable risk-reward ratio. 2. Confirm the pullback is stabilizing. Look for a bullish candlestick pattern on the 4-hour chart, such as a hammer or bullish engulfing candle. This confirms that buying pressure is returning at this support level. 3. Enter a long position at 1.0792. Set your stop-loss just below the recent low at 1.0750. This limits your risk to 42 pips. 1.0792 minus 1.0750 is equal to 0.0042. Never risk more than 1 to 2% of your trading capital on a single trade, so adjust your position size accordingly. For example, if you have a $10,000 account and risk 1%, you can risk $100 per trade, at 42 pips. That means a position size of 0.2 pips of profit, 1.0856 minus 1.0792 is equal to 0.0064, a risk-reward ratio of 1.5 to 1. Once you take partial profits, 50% of your position, move your stop-loss to break-even, 1.0792, to protect your remaining profits. 0.5. Let the remaining 50% of your position run to the next resistance level at 1.0900. This gives you 108 pips of profit, a risk-reward ratio of 2.5 to 1. If the price hits 1.0900, take the remaining profits. If it pulls back below the break-even level, exit the trade with no loss. This strategy is beginner-friendly because it's not aggressive. It waits for the market to come to you, uses a clear stop-loss, and has defined profit targets. It's designed to capture the short-term bullish pullback without exposing you to excessive risk. Strategy 2. Breakout trade, intermediate, medium risk. For intermediate traders who want to capture a stronger rally, this breakout strategy leverages the key resistance level at the 50-day MA, 1.0856. Breakouts above key resistance levels are strong bullish signals, and this strategy aims to capture the momentum after the breakout is confirmed. Here's the step-by-step. 1. Monitor euro to US dollar as it approaches the 50-day MA at 1.0856. Do not enter the trade until the price breaks above this level. Breakouts need confirmation to avoid false signals. 2. Not a false move. 3. Enter a long position at 1.0860, slightly above the breakout level to avoid getting in too early. Set your stop-loss just below the 50-day MA at 1.0850. This limits your risk to 10 pips, which is tight but effective for breakout trades. False breakouts will trigger the stop-loss quickly, minimizing losses. 4. Take partial profits at the next resistance level at 1.0900. This gives you 40 pips of profit, a risk-reward ratio of 4 to 1. Move your stop-loss to break-even, 1.0860, after taking partial profits. 5. Let the remaining position run to the 100-day MA at 1.0921. This gives you 61 pips of profit, a risk-reward ratio of 6.1 to 1. If the price hits 1.0921, take all remaining profits. If it pulls back below break-even, exit with no loss. The key here is patience. Do not enter the trade until the breakout is confirmed. False breakouts are common in Forex, so waiting for a 4-hour close above the resistance level is critical to avoiding losses. This strategy is medium risk because it uses a tight stop-loss, but the potential rewards are much higher than the beginner strategy. Strategy 3. Short-term scalping, advanced, high risk. For advanced traders who are comfortable with high-frequency trading and tight risk management, this scalping strategy leverages the 60-minute chart to capture small, quick, and use the 5-period and 10-period MAs as your key indicators. The strategy is to buy when the 5-period MA crosses above the 10-period MA, bullish crossover, and sell when the 5-period MA crosses below the 10-period MA, bearish crossover. 2. Enter a long position when the 5-period MA crosses above the 10-period MA on the 60-minute chart. Current crossover level is around 1.0810. Set your stop-loss 10 pips below the crossover level, 1.0800, to limit risk. 3. Take profits at 15 to 20 pips above the entry level. For example, if you enter at 1.0810, take profits at 1.0825 to 1.0830. This gives a risk-reward ratio of 1.5 to 1 to 2 to 1, which is critical for scalping. You need more winning trades than losing ones, so keeping risk-reward favorable is key. 4. Repeat this process throughout the day. Enter on bullish crossovers, exit at 15 to 20 pips, and cut losses at 10 pips. Avoid holding positions for more than 1 to 2 hours. Scalping is about quick profits, not long-term holds. 5. Only trade during high-volume sessions, the London session, 8 a.m. to 4 p.m. Greenwich Mean Time, and the New York session, 1 p.m. to 9 p.m. Greenwich Mean Time, have the highest volatility for euro to US dollar, which is essential for scalping. Avoid trading during low volume sessions, e.g., Asian session, when volatility is low and spread consistent daily profits now. Let's move to pound sterling to US dollar strategies. Remember, pound sterling to US dollar has stronger short-term momentum than euro to US dollar, so our strategies will be slightly adjusted to account for that, but the core principles, risk management, key levels, confirmation, remain the same. Strategy 1, buy the dip, beginner-friendly, low risk. This is the mirror of the euro to US dollar beginner strategy, but adjusted for GBPUSD's key levels and stronger momentum. Here's the step-by-step. 1. Wait for pound sterling to US dollar to pull back to the 20-period MA on the 4-hour chart, which is currently around 1.2615. This is a key short-term support level, and buying here allows us to capture the continuation of the short-term rally. Point 2. Confirm the pullback is stabilizing. Look for a bullish candlestick pattern on the 4-hour chart, hammer, bullish engulfing, to confirm that buying pressure is returning. Point 3. Enter a long position at 1.2615. Set your stop loss just below the recent low at 1.2489. This limits your risk to 126 pips. 1.2615 minus 1.2489 is equal to 0.0126. Again, adjust your position size to risk no more than 1 to 2% of your trading capital. For a $10,000 account risking 1%, that's $100 per trade, position size of 0.08 lots, 126 equals tilde 0.79, so 0.08 lots, 0.4. 47 to 1 ratio, then the second target at 1.2715, 100 pips, for a 0.8 to 1 ratio. Wait, no, let's correct that, the stop loss is 126 pips, so the first profit target should be at least 126 pips to get a 1-to-1 ratio. So, first profit target at 1.2741, 1.2615 plus 0.0126 is equal to 1.2741, which is just above the 50-day MA at 1.2715. Take 50% of profits here, then move stop loss to break-even. Point 5. Let the remaining 50% run to the 100-day MA at 1.2783. This gives you 168 pips of profit, a risk-reward ratio of 1.33 to 1. If the price hits 1.2783, take all profits. If it pulls back below break-even, exit with no loss. This adjustment ensures that we maintain a favorable risk-reward ratio, even with GBPUSD's wider stop loss. The key is to be patient and wait for the pullback to the 20-period MA. Don't chase the rally. Strategy 2. Breakout trade, intermediate, medium risk, like the euro to US dollar breakout strategy. This one focuses on the 50-day MA at 1.2715, but GBPUSD's stronger momentum means the breakout is more likely to be sustained. Here's the step-by-step. 1. Monitor pound sterling to US dollar as it approaches the 50-day MA at 1 point. Profit, risk-reward ratio of 4 to 1. Move stop loss to break-even, 1.2720, after taking partial profits. Point 4. Let the remaining position run to the 100-day MA at 1.2783, 63 pips of profit, risk-reward ratio of 6.3 to 1. Take all profits at 1.2783, or exit if price pulls back below break-even. GBPUSD's stronger momentum means that the breakout is more likely to continue, so this strategy has a higher probability of success than the euro to US dollar breakout trade. But still, patience is key, or wait for confirmation before entering. Strategy 3, short-term scalping, advanced, high risk. This scalping strategy is similar to EUR to USD's, but adjusted for GBPUSD's higher volatility and wider spreads. Here's the step-by-step. 1. Focus on the 60-minute chart for pound sterling to US dollar. using the 5-period and 10-period MAs for crossovers. Enter long on bullish crossovers, short on bearish crossovers, but since pound sterling to US dollar is in a short-term bullish trend, we'll focus on long trades. Point 2. Enter a long position when the 5-period MA crosses above the 10-period MA on the 60-minute chart. Current crossover level is around 1.2640. Set your stop loss 15 pips below the crossover level, 1.2625, to account for Asian sessions, as spreads widen and volatility drops. Point 5. Stick to the rules, exit at profit targets, cut losses at stop losses, and don't hold positions for more than 1 to 2 hours. Discipline is key for scalping, and even a small deviation from the rules can lead to significant losses. Now, let's talk about risk management. This is non-negotiable for any Forex trade, regardless of your experience level. For both euro to US dollar and pound sterling to US dollar, remember these key rules. 1. Never risk more than 1 to 2% of your trading capital on a single trade. This ensures that even if you have a string of losing trades, you won't blow up your account. Point 2. Always use a stop loss. A stop loss is your safety net. It limits your losses if the trade goes against you, and it takes the emotion out of exiting a losing trade. Point 3. Adjust your position size based on your stop loss. The larger your stop loss, the smaller your position size should be to keep risk within your 1 to 2% limit. Point 4. Be aware of potential risks that could reverse the trend: Fed policy shifts, ECB BOE rate announcements, economic data surprises, and geopolitical events, e.g., trade tensions, political instability in the Eurozone or UK. Now, let's summarize the key takeaways for euro to US dollar and GBPUSD. Both pairs are in short-term bullish pullbacks within longer-term bearish trends. Euro to US dollar has weaker momentum, while pound sterling to US dollar has stronger momentum. Fundamental drivers include Fed hawkishness, ECB BOE dovish hints, and economic data from the US, Eurozone, and UK. For beginners, use the buy the dip strategy, focusing on key support levels and tight risk management. For intermediates, use the breakout strategy, waiting for confirmation above key resistance levels, 50-day MA, to capture stronger momentum. For advanced traders, use scalping strategies on the 60-minute chart, focusing on high-volume sessions and tight profit-loss targets. Remember, trading Forex is not about being right every time, it's about being profitable over time. Stick to your strategy, manage your risk, and don't let emotion drive your decisions. Now, let's move on to Category 5, Bitcoin and US stock indices.